All right, welcome to this explainer. Today, we're putting on our sell-side equity analyst hats for a rigorous teardown of Itron's fundamentals. We're going to build out a detailed valuation framework, and we are strictly using the hard data extracted directly from their latest financial presentations and earnings transcripts. Our main goal here? To bridge that gap between management's operational narrative and the actual undeniable math driving the stock's intrinsic value. Let's dive in. Here's our game plan. We'll start with the Itron investment thesis, move into a segment and geographic breakdown, look at their target 2027 operating model, and finally wrap it all up with our DCF valuation framework. Starting right off with Section 1, the investment thesis. Before we crunch any numbers, we absolutely have to understand what Itron actually does. At their core, they're an industrial Internet of Things and edge intelligence leader. Basically, they solve mission-critical energy and water problems for utilities and cities. I love this quote from management's Q1 2026 call because it perfectly captures their competitive moat. They said, "The reason we are winning is straightforward. We help customers make one investment dollar do more." Now, as an analyst, when I hear that, what I'm really hearing is a company that's deeply embedding itself into its customers' infrastructure. They are creating value across an asset's entire useful life, which essentially locks in highly durable recurring revenue for them. And you can see that value proposition translating directly into financial security. This ability to stretch customer dollars has literally turned into a massive $4.5 billion backlog as of mid-2025. Yeah, $4.5 billion with a B. In the world of equity valuation, a massive contracted backlog like that heavily de-risks our future cash flow projections, especially for years 1 through 3 of our forecast. Just to wrap your head around the sheer scale of their operation, Itron currently has over 112 million endpoints under management globally, and that's spread across more than 8,000 customers in 100 different countries. So we're not talking about some speculative growth story here. This is a massive, deeply entrenched footprint. Okay, moving right along to Section 2, the segment and geographic breakdown. Let's look under the hood to understand exactly where this cash is coming from. Looking at their 2024 revenue mix, you'll see that networked solutions make up the absolute lion's share at 66%. That's followed by their baseline device solutions at 19%, and then the higher margin outcome segment at 15%. This breakdown is super vital for our forecast. Why? Because the growth and margin profiles of these three segments are fundamentally different from one another. Now, when we map out revenue dependency by geography, any rigorous analyst has to highlight concentration risk. And there's a big one here. We've got a significant dependency on North America, making up 82% of the overall geographic mix. EMEA sits at 13%, and APAC is trailing at just 5%. So moving forward, our model has to assume that long-term growth will be heavily tethered to North American infrastructure spending and GDP. All right, on to Section 3, the Target 2027 operating model. This right here is the crucial bridge for our valuation, where the magic really happens for free cash flow generation. Management's guided strategy hinges on a very deliberate rotation. They are purposefully moving away from those foundational lower-margin device solutions and rotating up toward their higher growth, much higher margin networked software and outcomes. When you reconstruct their segment targets, this profitability pivot is just crystal clear. Device solutions are sitting at 24 to 26% gross margin, but then network solutions jump up to 38 to 40%, and outcomes scale all the way up to between 43 and 45%. Basically, the more they sell from that top tier, the higher the blended corporate margin becomes. Zooming out to the consolidated level, these segment shifts culminate in a top-line target of up to $2.8 billion by 2027. And honestly, the most important takeaway here is their free cash flow generation target of 10 to 12% of revenue. As an analyst, this metric is pure gold. It gives us a direct, management-guided bridge from total sales right down to actual cash generation. Which brings us to Section 4, our discounted cash flow valuation framework. Let's take all these targets and map them into something actionable. So, because the provided filings give us fantastic operational targets but obviously omit granular balance sheet details and a historical beta, rigorous analysis means we've got to draw a line in the sand. We explicitly separate the documented operational data, like those 2027 targets we just looked at, from the sensible, external default assumptions we need to complete the underlying math. So, our model progression requires 3 strict steps. Step 1, we project the top line to that $2.8 billion goal, leaning heavily on that $4.5 billion backlog momentum. Step 2, we bridge to unlevered free cash flow using management's stated margin profile. And finally, step 3, we applied benchmarked discount rates to bring it all back to a present value. Here's a neat shortcut. To derive our unlevered free cash flows, we can actually bypass all those standard, messy, non-cash adjustments. Depreciation, amortization, working capital changes. Why? Because we can strictly utilize management's explicit target of converting up to 12% of top-line revenue directly into free cash flow. On $2.8 billion in revenue, that outputs a massive $260 to $336 million annually in pure cash generation by 2027. To finalize the intrinsic value, we just need to lock in some sensible defaults. For terminal value, we're utilizing a 2.5% growth rate, which is totally consistent with long-term GDP and Itron's primary North American markets. And for our cost of equity, via CAPM, we assume a standard 5 to 6% market risk premium. That provides a really solid conservative discount rate for those future cash flows. All right, so we've seen exactly how Itron plans to scale its edge intelligence and capture those higher margins. But I want to leave your investment committee with this final thought to explore. Given their heavy geographical concentration in North America, exactly how durable is that $4.5 billion backlog if the broader industrial cycle turns? It's something you definitely want to think about. Thanks so much for joining me for this explainer, and as always, keep digging into the data.